I'm Anthony Smith with HFG Trust, and this is the Chart of the Week video. Hello and welcome to our weekly video. Was there ever really any doubt what we'd be highlighting in this week's video? I've had yesterday's Fed announcement on my calendar for a month now. That was the most widely anticipated meeting in quite some time. There's a lot to cover here. I'll pick a handful of the highlights. Of course, please call us if you'd like to discuss anything further. So with that, let's jump into it with a little bit of a background. The Fed has 8 official meetings per year at which it reviews economic and financial conditions and its monetary policy response, if any. It also has 2 mandates, maximum employment and price stability. There is no official third mandate to ensure stable and or rising stock prices, but you'd be forgiven if you thought that was the case. Okay, so the Fed has lots of tools at its disposal. 2 major ones are short-term interest rates and quantitative easing, which some people might call money printing. So on Wednesday, that was yesterday, after its 2-day meeting, it released a statement. And by the way, I have the statement right here. It's easily digestible, not intimidating at all. I encourage you to give it a read if you are curious. So in this statement, the committee finally seemed to acknowledge that inflation might just be sticking around for a bit after all. So let's look at the exact wording from the statement. And we're going to start with September statement, so the previous statement. So we have a baseline, and I have the exact quote right here regarding inflation. Inflation is elevated, largely reflecting transitory factors. Okay, that's from September. I have from yesterday, we have inflation is elevated, largely reflecting factors that are expected to be transitory. Wow, that was it, folks. If you blink, you missed it. This is the kind of hair splitting that can move markets. So another big piece of this announcement was that tapering will begin. So the Fed has been creating money to buy $120 billion worth of treasuries and mortgage-backed securities per month to support financial conditions during the pandemic. Now they're going to taper, meaning that they will reduce that $120 billion by $15 billion per month. So that'll put them on pace to end this round of quantitative easing by June next year, at which time they may start raising rates, but not until then. So tapering is big news, but it was expected for the most part. The part that I didn't expect, but certainly welcome, is that the Fed added that it could accelerate or decelerate the pace of tapering. So that's big news, because if inflation stays high, the door is open to ending quantitative easing sooner, such that they can get to a point of raising rates sooner in order to tighten financial conditions to fight inflation if it does indeed persist. That's the thinking anyway. All right, so how did financial markets respond to this announcement yesterday? I'd call it a fairly muted reaction. Stocks were up, bonds didn't change a whole lot. Today, however, bond yields are a lot lower, and that's likely due to, in England, the Bank of England did not raise rates today as was expected. So that's a missed opportunity. When the market expects a central bank to raise rates, you got to raise rates. So this is, like I say, missed opportunity, and I think it sends a negative signal to the markets. So that's kind of what's driving yields lower today. Lots of elements are impacting markets here and there. It's always kind of challenging to point to one thing, but overall, getting back to the announcement yesterday and the reaction, fairly muted. Okay, so I want to end with another key takeaway from all this, and it's more related to your investment portfolios. So we do not project interest rates, but it's fine if we talk about possibilities, right? So if we are indeed transitioning from loose monetary policy to tight monetary policy, then rising interest rates would be a natural byproduct of that. Yields are very low across the board right now on short-term bonds, long-term bonds, they're just low. If your bond allocation is primarily in short bonds, then you won't be all that impacted, or you won't be impacted too negatively if rates do rise, because your short-term bonds are going to be maturing and reinvested at those higher yields as time goes by. If, however, your bond portfolio is primarily in longer-term bonds, then you will be negatively impacted to a greater degree, because your portfolio of bonds and low yields are locked in for a period of time while rates are rising around you. So that is it for now. Thank you very much for watching. We'll see you next week.